Welcome to the deep dive. So you sent over this really interesting piece from the Motley Fool. It's called Better Dividend Growth Stock, Costco versus Visa. And, well, right away, it kind of throws us into that classic investor question, doesn't it?
It really does. Comparing two giants, but specifically through that lens of dividend growth.
Exactly. So our goal here, our mission for this deep dive, is to really unpack that comparison. We want to get to the key insights so you can figure out, which one might be a better fit for your dividend growth plans.
Or perhaps if holding both makes sense.
Right, or if both deserve a look.
And the article starts off with something really fundamental, something that's, well, critical for you, the listener, to grasp. It really highlights how important dividends have actually been for overall stock market returns historically.
Yeah, it drops a pretty amazing statistic, actually. It says something like 85% of the S&P 500's total return since 1960 comes from reinvesting those dividends and, the power of compounding.
It really puts things in perspective. It's not just about the stock price going up.
Not at all. It makes you rethink where the real returns often come from.
And there's more. What's really compelling, especially if you're thinking long-term, is that the article points out that companies that consistently grow their dividends, well, they haven't just beaten the market since 1973. They've also done it with less volatility, fewer big swings up and down.
Less stress, basically.
Very much.
Yeah.
So right from the get-go, the article builds a strong case for why looking closely at the dividend growth potential of companies like Costco and Visa is, well, a really smart approach for your strategy.
Okay, let's dive into Costco first then. I mean, most people know Costco, right? You walk into one of those huge warehouses.
Oh, yeah.
And you get the model immediately. Membership-based, focus on value. And it seems to work. They have this incredibly loyal customer following.
Absolutely.
Yeah.
And the article mentions they operate on, let's say, thinner margins compared to some retailers, but they just move so much product, incredible volume.
And that model, it seems, has translated into a really dependable dividend record.
Yeah, it has. The article notes 20 straight years of increasing their dividend payout.
20 years. That's commitment.
It really signals a dedication to returning value back to shareholders, back to you.
And it's not just tiny increases either, right? The growth rate's been pretty good.
Very good, actually. Over the past decade, the average annual dividend hike has been 12.6%.
12.6% average per year. That's definitely outpacing inflation.
Comfortably. It means real growth in the income you receive year after year.
Now, here's something interesting the article brings up. The current dividend yield is, around 0.47%, which sounds kind of low.
It does seem low at first glance. But, and this is a key point the article makes for you, that lower yield isn't necessarily a sign of weak dividend growth.
Okay, so why is it low then?
Well, in Costco's case, it's largely because their stock price has gone up so much, especially since 2015. The article even shows a chart, apparently, comparing Costco's stock performance to the S&P 500.
Showing it's outperformed.
Exactly. So the stock price appreciation has been so strong that it's kept the yield percentage looking modest. Even while the actual dollar amount of the dividend has been growing nicely, you're getting growth in the share value and growth in the dividend payment.
Got it. So the denominator, the stock price, grew faster. Okay. And looking forward, what about the potential for future dividend growth? The article mentions their payout ratio, right?
It does, and it's a crucial metric for you to consider. Costco's payout ratio is around 27%. Pretty conservative.
So they're only paying out about a quarter of their earnings as dividends.
That's right. And that low ratio is a really positive signal. It means they're keeping a lot of their earnings, which gives them a big financial cushion. It strongly suggests they have plenty of room, plenty of capacity to keep increasing those dividends in the future without straining themselves.
And the business itself seems rock solid to support that. The article throws out some big numbers for fiscal 2024, like $250 billion in net sales.
Huge number. Up 5% year over year, and nearly 137 million cardholders.
Wow. That's a massive loyal base.
It points to a very solid, still growing foundation. And you combine that with what the article describes: strong cash flow, very little debt, disciplined capital allocation.
Right.
It really paints a picture for you of a financially healthy company ready to keep growing that dividend. Plus, their whole business model is pretty resilient, isn't it? Even with all the competition in retail.
Yeah, that membership fee provides a nice buffer. So, the takeaway for Costco seems to be solid track record, good growth, conservative payout, strong underlying business.
Appealing if you want both income growth and maybe some capital appreciation, too.
A very compelling case, as the article lays it out.
Okay, let's switch gears then. Visa. Totally different world, right? No warehouses full of stuff.
Completely different. They're all about payments technology, global scale.
They run that massive electronic network connecting, well, everyone involved in a payment, basically.
Pretty much. Consumers, merchants, banks, governments. The article says they operate in over 200 countries.
And it's important to remember they don't actually issue the cards or lend the money. Exactly. The article makes that clarification for you. They're not taking on credit risk. They provide the infrastructure, the rails for digital commerce.
Okay. And their dividend growth story. The article used the word extraordinary.
Yeah, that stood out to me too. And the numbers seem to back it up. Their 10-year average annual dividend growth rate, 17.5%.
Whoa, okay, 17.5%. That is significantly higher than Costco's 12.6%.
Quite a bit higher. Real acceleration there for you as an income investor.
And they also have a streak of increases, though maybe not as long as Costco's.
Correct. 16 consecutive years of raising the dividend. Still very impressive, very reliable.
16 years is nothing to sneeze at.
Not at all. And if you're looking at the current income, Visa's yield is a bit higher too. The article says 0.71% compared to Costco's 0.47%.
So still not a high-yield stock, but relatively speaking, you get more income upfront per dollar invested?
Over 50% more current income, yeah.
And what about their payout ratio? Is it also conservative?
Even more so, actually. Just 21.7%.
Wow, okay. So even lower than Costco's 27%.
Right. Which suggests to you, potentially, even more flexibility and room to boost that dividend significantly going forward. It really highlights the potential for continued strong dividend growth.
The article seemed quite positive about Visa's actual business model, especially regarding dividends. Why is that?
Well, think about how they operate. It's fascinating, really. They have these incredibly high profit margins. They don't need a ton of capital spending compared to, say, a retailer building stores and warehouses. And it's really hard for competitors to enter their space, significant barriers to entry.
Like a toll road, almost.
That's the analogy the article uses. It's insightful. They collect a small fee on a massive volume of transactions flowing through their network without the overhead or the credit risk.
That makes a ton of sense. And there are bigger trends working in their favor, too, right? Like people using less cash.
Absolutely. The article highlights that global shift from cash to digital payments as a huge long-term tailwind for Visa.
More transactions online, more tap to pay.
Exactly. As that volume grows and as they expand in emerging markets where cash is still king, well, Visa is just perfectly positioned to benefit. And that asset-light model means more free cash flow generated.
Which fuels the dividend growth.
Precisely. It supports that impressive dividend growth trajectory for you.
Okay, so we've laid out the cases for both. Costco, strong, steady, resilient. Visa, higher growth, lower payout, benefiting from digital trends. Now, the big question you probably have, the article's verdict. Which one is the better buy for dividend growth?
So, based on the analysis in the piece, Visa comes out slightly ahead if your main goal is maximizing dividend growth.
And why exactly? Just to recap the key reasons.
It boils down to Visa's higher historical dividend growth rate, that 17.5% average.
Right.
The even lower payout ratio, giving them more room to run.
The 21.7%.
Yes, and that slightly higher current yield offering a bit more income now.
Plus the business model advantages we just talked about.
Exactly. The article suggests that asset-light model and the tailwind from digital payments create a really strong foundation for potentially continued double-digit dividend increases for you.
But it wasn't a completely one-sided conclusion, was it? The article suggested maybe owning both.
Yes, and that's an important nuance for you to consider. While Visa gets the nod for pure dividend growth focus, the article points out they are very different businesses in different sectors.
Retail versus financial tech.
Right. So owning both could offer good diversification for your portfolio while still benefiting from two companies clearly committed to shareholder returns through dividends. The ideal situation for many, as the article puts it.
Okay. But bottom line, if you had to pick just one based on the article's analysis for dividend growth.
If you could only choose one, the article concludes Visa rings up as the modestly better choice, specifically for that dividend growth objective.
All right. So wrapping this up, what are the key takeaways for our listeners?
I think the main points are both Costco and Visa are really strong companies with great dividend track records. No question there.
Definitely quality businesses.
But if you're zeroing in on dividend growth potential, this specific analysis suggests Visa has a slight edge based on that faster historical growth, lower payout ratio, and the current yield.
So for someone prioritizing that growth aspect, Visa looks maybe slightly more compelling according to this article.
That seems to be the conclusion, yes.
And it really hammers home that point from the beginning, doesn't it? Dividend growth isn't just a small part of the equation. Historically, it's been a huge driver of returns, makes this kind of analysis really relevant for long-term investors like you.
Absolutely. Which leads to a final thought, maybe something for you to mull over personally. Thinking about your own goals. Are you looking more for current income right now, or is maximizing that future dividend growth the top priority?
Good question. Income now versus growth later.
Does the article's conclusion about Visa versus Costco resonate with how you see them? And are there other things, maybe beyond just dividends like valuation or risk tolerance that you'd factor into your own decision?
Lots to think about there. How does this fit your picture? Excellent points.
Definitely worth considering how these insights apply to your specific situation.
Well, thanks for digging into this dividend duel with us. We hope this gives you some useful perspective. As always, we encourage you to explore further and think about how dividend pairs fit into your overall strategy. Until our next deep dive.